Hi everyone, my name is John Rasp and I'm presenting on stocks and information technology. Within my presentation, I plan to give a brief overview on how a stock trade works, the technology advances of stock trading, high frequency trading, and we'll end with discussion questions. This slide just shows a basic diagram of how a stock trade works in very simple terms. So a stockholder wants to sell their 100 shares of stock at $10 a share, and somebody else in the market wants to buy 100 shares of stock at $10 a share. The trading floor, basically the NYSE or NASDAQ computer system, will kind of match those two sets of trades. So that's very simple terms of how a stock trade works. There's been many technological advances with stock trading, especially in the last 20 to 25 years. The investors have unprecedented access to company information. Before, investors only could get an annual report and basically read the newspaper for anything related to the company. But now you can go to the website, you can review information that different companies have on how they think. So there's a lot of different information out there that 20 years ago you would never be able to have access to. The second thing is pricing. You don't realize how hard pricing was until you kind of see what people used to have to do. And that image on the slide is, hey, you used to have to go to the newspaper and look at this long Wall Street Journal, look through the stocks and find the stock amount, find how much it went up that day. But that was basically the closest thing you could get without calling the broker and seeing what the price was trading for. So trades are almost real time. You can get them for any company, and you don't have to go through a newspaper and kind of look at that. The other thing is with share certificates. It used to be that companies would issue a share certificate and that they would trade it between people. So I know when I was talking to somebody up in New York in our Fidelity office who used to work on Wall Street prior to his job at Fidelity in the 60s, he mentioned he has to physically carry certificates around as a 16-year-old from one company to the next. So it was really hard to trade shares because you actually had to trade physical certificates. So trading is much easier now. They're very inexpensive. You can go on any cheap site or even the more established companies and trade very easily. The other thing that's happened, and I'll talk a little bit more about, is high frequency trading, but computers making trading. And the other thing is very similar to that is automatic trading and how things are automatically being done based off a set of triggers. High frequency trading is one of the more common terms that you hear, and it's very recent and it's very advanced. But basically, investment companies or investors try to profit from price swings by large institutional trades. In simple terms, you have large funds. I know some of the largest mutual funds in the world are $100 billion or more. Well, you even say if they trade 1% of their shares for that day, that's $1 billion that they're trading in shares. So obviously that's going to impact the market very closely. The other thing that impacts the market very significantly are pensions. So large pensions who are managing funds are kind of handling their money and moving things back and forth. That can really influence a stock. Basically, high frequency trading involves buying when the price is below the trend and selling when it's above trend. So if you look at the chart that recently popped up, you can see that yeah, high frequency traders are looking at, there's a large trade that comes through, rather than being a significant drop, they're doing a lot of buying and selling, which causes the kind of to smooth out the normal price for a fund. One of the reasons that high frequency trading has really got a lot of publicity is the flash crash that happened in May 6, 2010. This event wiped out $1 trillion in market value in the span of less than an hour. As you'll see from the chart here, you'll see how the S&P really dropped, and they're still investigating. Actually, they extradited somebody recently who they thought was doing a lot of high frequency trading that caused this, but they said a lot of it was due to a lot of computer trades happening, a couple triggers hit, some high frequency traders were out there, caused this crash basically, and it was so quick due to the computers hitting and triggering different stock trades. High frequency trading has really changed how stocks are traded on a daily basis. More than 70% of the daily trades are now done through high-frequency trading. The average holding period of a stock is now only 5 days. To give you some perspective, 50 years ago, it was around 8 years. So somebody purchased a stock 50 years ago, 8 years would pass before they would try to get rid of that stock. And the other kind of scrutiny that high frequency traders have taken is they can flood the market with bogus orders. As you kind of see from the chart below, there's a lot more quotes being placed and people kind of quoting different stocks but not actually making trades. And people are suspecting this is because high frequency traders are kind of trying to flood the market and try to pretend like they're going to buy something even though they're not. So it's really impacting how the market reacts to that. There are four basic questions I want to touch on during my discussion. With the advancement of the technology in stock trading, do you feel that it harms or helps the average individual investor? So hopefully all of us in our lifetime will be individual investors, but how do you think the technology has really impacted you in terms of trading? Do you think high frequency trading should be illegal? There's a lot of thoughts on that, but there's also a lot of benefits that people see that it's smoothing over the market and making it not too rough to do trades. And the other thing is, do you think that there's been a lot of scrutiny due to the stock market and the technology around it? So are people more skeptical of the stock market? And then my last question is, follow the stock markets, whether you're a seasoned investor or not seasoned, what do you think is the most beneficial change that is hit? This last slide just represents my references used for the presentation.